So good evening, everyone, and thank you everyone for joining in. So I know today it's a very exciting topic and something very close to me also, because I feel this is 18-20 years I am also in this business, and I realize that people who created wealth is nothing but managing their behavior well. And just to give a perspective that over a 13-year period, let's say our Sensex or Nifty has delivered 12-13% return compounding, but when I meet average investor, their returns have been 7-8%, 6%, because of the various reasons, right? So we have seen this kind of behavior gap in most of the investors, including me. I would not say that I have any saint here, but that is where we thought, let's have some insights coming in from none other than Mr. Kalpen Parekh, who is Managing Director and Chief Executive Officer of DSP Mutual Fund, and he is member of their executive committee. He is always known for his long-term investing principle, and he has a strong belief that behavior and evidence-based investing are the source of alpha. Just to give background about Kalpen, he holds a management study degree in finance from NMIMS. He joined DSP in 2017. He has a 19-year plus experience, and he has served various roles in various industry level positions. So I'll not take much time between you and Kalpen, and I'm sure we have some very exciting things coming in next 1 hour. So Kalpen, I'll leave the floor to you, and thank you.
Thanks, Tarun, for inviting me, and thanks for all of you listeners who have joined on a rainy Friday evening. You could have spent your time doing better things, but since you have chosen to listen to me, I can't do much about it. I'll try and do justice. What I've tried to do is, I've spent 24 years now in the investments industry and business, and it has shaped me and helped me become a slightly less poorer investor. I won't use the word a better investor, because that journey is always incomplete. But first 8 to 9 years, the way I used to invest is how 99.9% investors invest, and most often it results in behavior gap. What Tarun mentioned at the beginning, that while markets on a very, very long term have delivered 13% compounding per annum, and 13% is very powerful. It means that every 5.5 years our money doubles. So that's the power of long-term investing. However, most investors end up earning 4, 5, or 6% returns, because they don't invest at the right time, or they don't stay invested for the right time horizons. And there are a lot of things which are vying for our attention, as well as our hard-earned capital, which make us, or which force us in making a lot of mistakes. So what I've tried to do is summarize my 24 years of mistakes into just 3 or 4 big mistakes that have, always given me a poor investment experience. And my belief is that investing is a minority game. Investing is not a majority game. Only the minority wins here. It is a loner's game. So, what not to do is more important than what we should do. And to learn what not to do is to just observe how crowds behave, how masses of investors behave in every market cycle, or in every asset class popularity. And if we know what not to do, half the battle is won. In fact, 80% of the battle is won if we know what not to do. So I've just picked up 3-4 of my personal errors, and they are not just my errors. I've seen that time and again, most intelligent people also make similar errors. And you and me may be very intelligent, maybe very intellectually sound in some or the other part of life, but that does not guarantee us to be a good investor. Good investing is not about intelligence or intellect or IQ. It is all about common sense way of avoiding mistakes. So with that backdrop, I think the first mistake that most of us make is, we like to belong. We like to be part of what everyone is doing. And which is why I said that, most often we end up playing the majority game, because we like to belong, because we are social animals. So today, we are all parts of hundreds of WhatsApp groups, right? I'm sure each one of you, when you wake up in the morning, you'll be getting a good morning message from 5 groups of your friends, or your family members, or of your colleagues, or of the industry in which you're working with. Every day you wake up, you will get some 3-4 data points around how US market has done, how dollar is behaving, how different asset classes are doing, apart from various other news item. So in the last 10 years, the explosion that has happened in interconnectivity, thanks to technology, thanks to so many social media platforms, if we are 700 crore human beings, and if let's say we are 100 crore human beings who are connected, because not everyone may be on these networks, we actually are inflicted with 100 crore opinions on a minute-to-minute basis. And in the long run, only 2 or 3 opinions are right. But every day, we are bombarded with thousands and thousands of data points and opinions, which unfortunately end up creating a lot of stimulus. So it is said that the biggest distraction in our life is the WhatsApp red star notification, or the Facebook notification, or the Twitter notification, or the Instagram notification, because every notification distracts us from what we are supposed to do. And this picture very beautifully sums up that if there are 2 shops and there is one shop which is selling the truth, which may be mostly inconvenient, and the truths are generally inconvenient, more so in the world of investing. And there's another shop which is selling a lie, and that lie is very reassuring, that lie is very comforting, that lie is very nice to hear. Most of us will queue up in the shop which is selling a reassuring lie. And I'll give you a few examples of what I mean by these 2 observations or statements. And even when we look at investing, let's say many times when big bubbles happen in a country, so I'll talk about our country, let's not talk about other markets, because we are exposed to the stories in our market. In the year 2000, or the year 2008, or the year 2017, or the year 2021, whenever markets have eventually then fallen by 15, 20, 30 or 50%, just 3 months preceding such large corrections, what the whole ecosystem starts doing is, unintentionally, unawareingly, being unaware, start promoting reassuring lies. I would say lies like the India growth story. Now, I'm by no means saying that there is no growth story in India. Of course, there is a growth story, and that is why you and I are talking together. But it gets exaggerated. It gets storified. It gets, colors of adjectives which are devoid of fundamental numbers and data points. In the year 2008, I remember the stories which were getting promoted, and I have myself been guilty and culprit of communicating these stories without any bad intention. It was just lack of sheer experience and knowledge. The stories we used to communicate was that India will become bigger than China. India is so underpenetrated compared to China, for example, that India infrastructure will become very large. The kilometers of roads that we lay out in the next 10 years will be much more than what China could do. Or, our road networks will be better, our power situations will be better, so on and so forth. Now, obviously, some progress happens in India. In India, progress happens 2 steps ahead, 1 step behind, 2 steps ahead, 1 step behind. But the point I'm making is that basis that narrative, when a lot of money got invested in sectors which were likely to be beneficiaries of such a large infra boost, since that day till today, 14 years have passed, and some of these sectors or funds or stocks have not earned even savings account return, and a lot of companies have actually got decimated. So, but everyone bought it. Everyone got into the bandwagon and the story because of the desire to belong. We all like to belong to something which is becoming very popular as investors. So if I look at even as recently as 3 years back or 4 years back, interest rates were moderating in India, and there was a lot of race to increase the YTM of the portfolio. And this is a question which is asked very often to me by my own team, by our investors, that kitna YTM milega, kitna yield zyada milega. So whenever there is a chase or a race for higher yield on a simple fixed income or debt paper, it can only happen because there is some excess risk which will earn you slightly more. So if a AAA bond of an HDFC Limited is earning 7.5%, but if something else, some other bond is earning 8% or 9% or 9.5%, that extra yield will come only because of risk, not because of any other rocket science or innovation. But most of us get carried away with that extra YTM, not the extra risk. The fact that it is coming because of risk is actually forgotten. Now, what happens is that, these are mistakes that I have made. I'm highlighting here not your mistakes. I'm highlighting the mistakes I have made and hoping that in the journey, I can communicate how you should avoid similar errors or mistakes. So in 2018, I remember, we had a very interesting fund which used to just buy 1-year money market instruments, and the portfolio yield was around 6.7%. In those days, interest rates were closer to 6.5, 6.6, 6.7. Now, the narrative in our industry was that if we add few more NBFCs to the portfolio, and some of these NBFCs were borrowing very aggressively at that point in time, it will straight away take my yield from 6.7 to 6.9 or 7%. So 0.3% extra, yield in the portfolio. Now, obviously, we all knew with our own experience of 15, 20 years, that is extra 0.3 is coming by taking some extra risk, either of that NBFC or of the illiquidity of those NBFCs or of slightly, inferior quality. But the assumption was that these are all 3-month, 6-month assets, so nothing can go wrong. And while you knew that you were taking some risk, but we justified by saying everyone else is doing it. Every other, fund house is having it, or every other investor is seeking these type of extra return yielding products. So we said, okay, let's take that chance. Now, risk does not come by knocking our door in the morning and telling us that today afternoon at 10 or 4 o'clock, I'm going to come to you. It comes unannounced. It comes from, anywhere like a lightning in the sky. And suddenly in September, October of 2018, the NBFC crisis erupted. And some of these 4 or 5 NBFC instruments which are earning that extra return suddenly had question marks on their survival. Almost 95% of them survived, and some of them did not survive, but we went through a huge NBFC crisis. And that was a lesson again, which I reinforced to myself, that never do anything because everyone else is doing it. And that's a lesson that I want to convey, that the 5 most, dangerous words in investing are everyone else is doing it. Startups, everyone else is doing it. Cryptocurrency 1 year back, everyone else was doing it. Global tech stocks, everyone else was doing it. NASDAQ, everyone else was doing it. So we get trapped into it. And I have been a victim of that. So that was, a point that I wanted to convey. And there's a very beautiful saying I read last week when I was preparing this presentation, which said that if 50 lakh people say something foolish, it still remains foolish. The foolishness of that, action does not go away just because more people are doing it. Or 50 lakh people invest foolishly, it will still be a foolish investment. It won't be an intelligent investment just because a lot of people are doing it. So just be conscious of, where is the herd investing? Where is everyone buying things without being conscious of what price we are paying for that asset class, what valuations are we paying? So just be conscious of that. In our own industry, I've given one more example of, trying to highlight to you that how do we get trapped in the in the game of taking extra risk when there are a lot of new fund offers which are launched back to back. Every week there's a new fund offer. Now, if one fund is launching a fund called XYZ, there are 10 other funds which will come with something very similar. And if you don't do that, you feel left out, that a lot of my investors will end up putting money with some other fund. Also, let me also do an NFO of similar style. So either these are new NFOs or these are theme funds, sectoral funds. Like last year, the flavor of the season was technology funds. This year, the flavor of the season right now is auto sector funds. In 2016-17, I remember the flavor of the season was small cap funds, because small caps were doing very well, and their last 1 year, 2 year, 3 year returns were looking very attractive. So that created an environment of promoting those funds and trying to raise a lot of new money. Or 2016-17 was the phase of credit funds. Last 18 months has been a trend of target maturity funds and so on and so forth. So point I'm making is that whenever something becomes a very popular trend, I'm not saying all trends are bad or all products in that trend are bad, but it's very important that you are the first one to invest there and not the last one, because trends eventually end. The spelling of trend is TREND, and the last 3 words are END. So trend has to end. What we as investors have to be aware of is that we are not buying a trend at the end. It is wiser if you buy the trend at the beginning. And at the beginning, 99% investors do not buy it because the last 5-year returns would be looking very poor. So today, if I were to tell you that please invest in ABC Pharma Fund, you will not want to invest because last 5-year returns of pharma funds look very poor. But that's because the early trend for the next 5 years may be starting now. So just be conscious of that. So what is my hack to minimize these errors in the future for myself is I look for product categories which are not popular, which are actually being deserted by investors. Because in my view, what I've learned is 99% human beings or investors are poor investors. They don't know the formula of good investing. They may not even have good advisors like Tarun Birani, who's been in the business for more than a decade or more, and who can guide well. They go by their own instincts and then end up making mistakes. So I look for product categories or asset classes which are somewhere being deserted. I look for those asset classes which are not popular on TV headlines or newspaper headlines. Many times, you'll see, like right now, I gave an example of the auto sector and the transportation sector. A lot of NFOs are coming, and you'll see a lot of newspapers actually coming up with headlines that this sector is turning around and is something worth investing. But when it becomes a wave, you should think twice. You should do your homework before jumping into it. So look for what's losing money in terms of past returns. Look for what's unpopular today. And what is unpopular today is generally profitable tomorrow. And what is very popular or profitable today is generally unprofitable tomorrow. So this is one very big error or behavioral bias which can keep us away from our capital or returns. Tarun, if you can move to the next slide, please. So this is my first mistake, and I'm just giving an example here. If you see this slide, I just want to highlight that, and then we ourselves, last year in December 2021, we launched a fund called Global Innovation Fund. Now the NAV of that fund is down around 17%. Global Innovation Fund basically invests in global tech companies and global semiconductor companies and global disruptive innovation companies like Zoom or Nvidia or Shopify or Amazon or Lamb Holdings. These are some amazing world-class companies, and these businesses are not available in India. But 1 year back, all these companies were so popularly chased by the rest of the world, and they were sitting on a 7 or 8 year high of past performance. So it was very tempting to raise these funds, launch these funds, and ask our investors to invest. So our intent was not bad, that we want investors to invest in some of the innovative business models of the world, and such business models are not available in India. And these companies can at times in a cycle generate very large profit pools bigger than the GDP of countries. So it's a very dominant a theme that we should own in our portfolio. But what in hindsight I'm talking was that the timing was a bit late. It was late in the cycle. Thankfully, just 2 weeks before the launch of this fund, I read an interview by the chairman of Intel, which he had given in the year 2001. And in the year 2001, the tech bubble had crashed, just the way it has crashed right now in the last 9 months. Something similar had happened in the year 2000, 2001, and 2. And somewhere towards the end of 2001, the CEO of Intel is telling analysts and money managers that what were you smoking, or what were you guys thinking when you decided to buy our company at very high valuations. So I remember the price to earning ratios were as high as 70, 80, or 90 times, which normally in the long term are only 20, 25 times. So he said, what were you, smoking when you decided to own our shares at such crazy valuations? And that interview somewhere, was good luck that it came in front of me when we were in the middle of, deciding to launch this fund. But we had to still launch the fund because we had already got regulatory approvals and we could not pull it back. So we made one shift and we said that we will launch this only as a systematic investment plan, and we will not take lump sum money. We will take only staggered money. So if you as an investor wanted to put 100 rupees, I would have taken only, let's say, 1 rupee and asked you to do 100 rupees over the next 100 months, which is roughly over the next 8 to 10 years to capture the cycle and not invest at the peak. As bad luck would have it, the global tech space corrected by 20 to 30%. This fund's NAV also corrected by 17%. But as good luck would have it, we last minute did not make that error, and we launched this as an SIP. And it turned out to be a blessing for the investors, because when NAVs fall, the investor can accumulate more and more units and take advantage of falling prices. So the lesson here is that whenever something becomes very popular, either stay away or do the opposite. Invest in a staggered manner rather than investing one time. Next slide, Tarun. Now, many times we make some of these errors also because we are culturally wired to always bow to authority. It's okay to bow our head in front of our parents, in front of our elders, in front of gods, in temples where we go. But anywhere else, do not bow your thinking to any authority in financial markets or even in politics or in any other field, because most people don't know the future. Prediction of future is actually futile, and I'm giving you some examples here again from my own 24-year journey. In 2008, I had a very an ex-colleague who was working with me, and he told me that you stay in Borivali and you travel almost 2 hours every day to reach our office in Volatility. Those days my office was in Volatility. So why don't you move nearby? And I know people like you and me who come from middle class roots will never be able to afford homes in South Mumbai. But if you buy this stock, and this stock was a stock called ABG Shipyard. It was a very popular stock in 2006 and 7, and it was going through the roof in those days. If you buy this stock, you'll make so much of money in this stock that from Borivali you'll be able to move and afford a flat in Churchgate. Now he said this in good intent because because he felt that the stock will make money, and I also in good intent put some money to buy that stock. Over time now, in the last 14 years, the stock is down by 99%. The company almost does not exist. It went into bankruptcy. But the error that I made was not asking that question that why should this stock make money? Just because it has gone up in the last 2 years does not mean it will make money in the next 10 years. Just because someone is recommending to me who is trustworthy for me, who I have trusted, in the last few years, does not mean the stock has the right to make money. So the question to ask always is that, and then this is just an example of a stock, but it would be similar when you're doing a portfolio of funds or a PMS or any asset class, that what are the drivers of returns for this company and what are the drivers of risk? Is the current stock price reflecting all the good news which has happened? Is the promoter really sound? Is the business model really robust? Is the company's balance sheet strong enough that it can surpass or navigate difficult situations which come once in every 10 years across the world economy? And if the answer to all of that is yes, only then you should invest. Otherwise, no. So this is just an example that when you bow to authority without asking the right questions, you can make these errors. Another example, exactly around the same time, I had a choice to move from working in Mumbai in my company. I had a choice to move to their headquarters in Hong Kong. So it was a career enhancing opportunity for me. And I was in doubt, should I go, should I not go? Because I was fond of my company and my colleagues around me. So just to get a second opinion, my ex-colleague then, my boss, again in good faith, made me talk to a very, very senior banker who is an iconic guy who has transformed banking in India. And there is no better banker than him that I would have interacted with in my entire journey. He would be like 2 decades or 2.5 decades senior to me. So very respected, iconic guy. And he told me at the peak of the growth bubble in 2008 that, as far as you can see in the next 10 years, next 15 years, next 20 years, India will grow by 10% CAGR, its GDP. Incidentally, that was the last quarter when India grew at 10%. Eventually, the global financial crisis happened. Then India went through its 4 or 5 years of poor growth, and then various events happened. World growth slowed down. Our own growth slowed down, and our average growth rate in these 14 years since 2008 to now is just around 7%. It's not the 10% as it was visualized. Now, why am I bringing out this story? I'm not trying to undermine that that banker didn't know. I'm only trying to highlight that almost no one knows the future. None of us have astrology powers, but yet we live in that illusion that just because I've done well in one profession, I can prophesize about another profession or about something else. So in good intent, we all say that yes, our country will grow, our country will progress because we have huge entrepreneurial skills, you have huge opportunity. But whether the country will grow at 10% for next 10 years is a very big forecast, and that didn't happen, and because of which even markets eventually consolidated or returns came down. So what I'm trying to highlight is, do not succumb to the seniority alone in making your investment decisions. Always ask that question that whatever people around me are talking, whether They are experts, they are, advisors, they are mutual fund CEOs, including someone like me, or they are journalists. Everything that they are saying is already there in headlines. So वो तो already भाव में आ चुका है. Market already knows it. So why should I get extra advantage of that? Hence, don't succumb to titles or ties. I have written the word ties because, many times, if you are in front of someone who's worn a suit or a tie, there is an illusion of expertise. Whether it is CEOs of mutual fund, whether it is the investment heads or the fund managers. When I travel to many locations in the country, in smaller towns, and a lot of people there believe, a lot of investors there believe that Mumbai se koi aaya hai to bahut zyada expert hoga, and I would like to just listen to their views. So again, it is bowing to authority and not bowing to rationality or evidence or data. Even with leaders, in our businesses, in our companies, in our schools and colleges, in our political lives, we blindly follow what leaders are telling. We never make anyone accountable for long-term forecasts which are done. You take any political leader of any political party in the last 50, 60, 70 years of our existence, and look at track records in terms of accountability, you will be disappointed. But yet we like to listen to them. We don't mind spending 1 hour listening to videos of so many political stalwarts. But in the end, you will rarely come out enriched from any learning perspective. Just because someone is an authority does not mean anything in terms of the outcome that authority will be able to create. Likewise, central bankers, every day, night, today, at least in our industry, we look for, how is the US market behaving? What is the US Fed doing? What is the Reserve Bank of India going to do? What are the governors of various central banks talking about inflation and interest rates? And I'm sure you all would know, last year when inflation started coming back, every central bank and every governor, every central banker said that don't worry, inflation is temporary, interest rates will not rise, we will be able to control this situation. But look at what happened, right? Now today, everyone has lost the plot over inflation, and all central banks have panicked. And one after the other, all of them are now raising interest rates. Likewise, when you look at money managers, and you ask a lot of us, none of us would have predicted that 1 year from now, interest rates would be much higher than what they are today. And yet, we believe today, when the same money manager who could not predict higher rates are predicting that rates will fall 1 year from now. Now, sometimes predictions will go right, but at large, they go right only because of randomness, very rarely because of the power to predict. Because the reason, predictions are difficult is because the world is a very complex adaptive system where when hundreds of forces are constantly interplaying with each other, and to put them in a formula and say that, okay, when these 100 forces mix in a certain ratio, this outcome will happen, is almost impossible. The universe, from a big picture basis, can be understood, but micro, small changes that keep happening on a daily basis are very difficult to understand. And most knowledge that is imparted in any industry, whether it is in lifestyle or food or how to lose weight or how to make money and so on and so forth, is in my words, I call it chauffeur's knowledge. I will give a small example to depict that. I think around 70 or 80 years back, when Germany was doing a lot of research during the First World War or the Second World War days, in terms of how to combat the other powers they were fighting with. Some of the best scientists of Germany, they were doing a lot of research and coming out with white papers, and then they were going around the country and making presentation about the new research which had come out. So Max Planck was a very celebrated scientist in his days, and he had come up with some very successful discovery, and he was invited by everyone in every town of Germany to go and talk. So he booked a car, and he had a driver who was going to move along with him for the next 45 days. So every day he would move to one location, one city, and then go and make his presentation. So after like 20, 25 days, and the chauffeur would sit down in the audience behind and listen to what Max Planck would talk about. So on the 21st or 22nd day, the chauffeur said, I am now too bored listening to this guy, saying the same thing again and again. So he went to Max and said that let's do a role reversal. Let me go on the stage. We anyways look very similar. And, let me present what you present. You also must be tired after such long travel. So why don't you sit on the last row and just listen and relax and let me go and present the whole case. So Max Planck said that, okay, it's a good experiment we're doing. Let's try it out. So the chauffeur goes on stage, and he, speaks for the next 1 hour very fluently, and very impressively. And the audience starts, clapping, and there are a lot of questions which come. And the chauffeur is actually able to answer these questions also, because he has been seeing this, 2-hour session every day over the last 20 days. And then someone asks a question, which was a new question, which was very difficult for the chauffeur to even understand. And then at that moment, he says that, gentlemen, your question is too, stupid, too dumb for me to answer for a man of my stature. I would invite my chauffeur, who's sitting on the last row, to come and answer this question. So the summary of the story is that, most knowledge is chauffeur knowledge, especially when you, read about markets in newspapers. Journalists will have comments about asset classes, about themes, about funds, about fund managers, but a lot of it is superficial knowledge. Chauffeur's knowledge means it is superficial. It's not authentic. It's not original. It's not coming out of direct, deep study. So always be conscious about that. Next slide, Tarun, and I think that's the last one. Yeah. So yeah, this is the last slide. I just want to highlight here that another very, very large error that most of us make as investors is we like to chase 5-star returns of the past, 5-star funds, fund managers which are rated 5-star, mutual fund schemes which are rated 5 stars, or asset classes which have got great returns in the past. And I'll give some examples of that. Between the year 2000 to 2003, equity markets in India actually came down, and over these 3 years, 100 rupee Nifty would have come down to around 60 rupees, so almost 40% erosion in value. And in those 3 years, interest rates in India started coming down. So Government of India bonds or gilt funds or funds which were investing in these government bonds actually delivered 16-17% CAGR return. So that is a type of return they made. They gave returns which even equity funds would not have given otherwise in the long term. And at the end of 2003, when you had to decide where to invest, and you were given the comparison for the last 3 years, equity as an asset class showed -40, fixed income as an asset class showed +40 in absolute terms. Most money went into fixed income. No one invested in 2003 in equity because the past returns were poor. And between 2003 to 2007, we've had the mother of all bull runs we have ever seen in India, where Nifty itself went up by 700%. 7 times was the growth of Nifty. Sensex from 3,000 went up to 21,000, whereas Government of India bonds just gave flat returns of 4.5% per annum. So chasing past returns is, like I said, a very big enemy of future returns. Then 2003 to 8, like I said, that equities delivered superior returns, 7 times growth. The India story became very popular. BRICS was a word which was coined by global experts, saying that emerging markets will be the heroes in the next decade, ruled by countries like Brazil, Russia, India, and China. So all the money should go to emerging markets, and within that to India. And within India, the story of infrastructure, in India's infrastructure will boom and grow and so on and so forth. And hence, at the end of 2008, a lot of money started coming in equity funds. A lot of money started coming in infrastructure funds. Even today, from Borivali to Churchgate, it still takes me the same 1.5 to 2 hours to travel that it used to be in 98. So the infra story has not changed much, but a lot of storytelling made investors buy into these funds. And then in the next 5 years, 2008 to 2013, actually Indian markets gave 0 returns. Global markets also almost gave 0 returns. Then that decade of 2010 to 20 did not belong to emerging markets. In fact, most emerging markets in dollar terms gave very poor returns, almost 0 to negative returns, including India. India's dollar return in that decade was just around 3 or 4%, adjusted for currency depreciation. But in that decade, global funds, especially US-centric funds, generated very high returns, led by technology companies and tech stocks, because their profit pools became very large. Tech companies became very large. The largest companies by market cap were companies like Apple and Amazon and Microsoft and Facebook and Tesla. So everything driven by tech became very successful. So last year, a lot of money started going into a global fund, so much so that RBI had to shut these funds because the limits were exhausted. And after a lot of money went there, this year, actually that cycle has turned negative. Those funds have given 15 to 20% negative return. So what do you do as an investor? First of all, always recognize that asset classes have cycles. Decide what are the boundaries of these cycles, when is the asset class at its closer to peak or at its bottom, and then accordingly decide how to invest. And avoid, do not chase outperformance. Do not chase very high past performance. Instead, invert and chase underperformance. Chase the asset class which in the near term is actually underperforming. For example, today, global equities are underperforming. So this is a good chance, if you don't own it enough, to start adding to your portfolio. Some pockets of Indian equities are underperforming. It is a good chance to start adding some of those pockets which are not doing well. For example, generally we would say do not invest in thematic funds. But if someone wants to invest in thematic funds, there are two sectors or themes which are going through a phase of underperformance. Technology is underperforming since the last 6 to 9 months. Healthcare is underperforming over the last 4 to 5 years. So just giving an example that how do you think about investing? Don't chase outperformance. Instead, learn what is underperforming and try to build a portfolio of those asset classes. So these are some examples. And at the end, I want to just end by saying that this date, 11 September 2001, I know all of you, I'm assuming all of you would remember, was a day or date when terrorists had attacked US, and they flew two planes on the Twin Towers, and both the towers were completely decimated. And that was a phase when there was so much of fear around the world as well as in US when it came to airline travel. So in the next 2 years, all efforts were made by the US government to tighten airline security. All efforts were made by even airline companies to put billions of dollars in enhancing their security. So before this plane attack, 1 out of 20 passengers were screened, or their bags or luggages were screened. After that attack, from that day till today, every passenger now is screened. So the screening mechanisms went up. They became very intense. A huge amount of infrastructure was created to focus on airport and airline security. And air ticket prices crashed in 2001 and 2, but airline travel dropped by almost 80%. People started traveling by road or by trains, but stopped traveling by airlines, in spite of the fact that it was never more safe to travel by flights than that period after 2001 September. But yet passengers, because of the event of September 2001 and the recent history and the recent tragic memories of that airline crash, they deserted air flying. And it took 2 or 3 years for things to normalize before air flying started picking up. So this is how, how we behave in life. Recent events, force us to assume that the future will also look very similar to the past. And we start behaving in an irrational manner. And that does not help in our investing journey. So I've always said that don't chase 5-star funds. Instead, learn to become 5-star investors, and learn to become 5-star investors by knowing the rules of accidents or bad investing behavior. And if you learn these rules, you can avoid them, you can minimize them, and hence in the journey become better, superior investors. So I think that's it from my side, Tarun. I had these 3-4 very big errors that can, if we avoid, can really take you into the top 5% league of investors in the country or in the world. So open to questions.
Thank you very much, Kalpen. I'm sure.
Tarun, I'll just take a half a minute break, just half a minute.
Sure. So, friends, kindly post your question and answers on the Q&A box. We will try to address each question. I think it's a brilliant opportunity to ask any questions which is coming to your mind. So please use this opportunity. So till the time more questions come in, Kalpen, I think you were talking about, I have some questions which
please.
One is you were talking about unpopular today and picking up something which is unpopular. So there is a concept of value traps also. And I think time and again, we have seen many things which are cheap available. Just because they are available cheap or they have fallen much more, are they good to buy? And like we are talking about China today. China is down almost 30, 40, 50%, but since 2 years, China is just not performing, right? So I think, how do investors avoid these value traps just because something is down?
Superb question, and very happy you asked this question. Actually, I should have covered it in my conversation. That two rules of investing are, buy what is good and don't overpay. So don't overpay. You can solve for by looking for what has underperformed in the past, because what has underperformed in the past generally becomes cheaper in terms of its margin of safety or the price you have to pay. But the second important rule is don't buy if it is cheap and it is bad. So the question to ask is that what are metrics which say that this is a good investment. So just because something is down 30% does not mean it cannot be down another 30 or another 90. So generally bad companies or companies, so I gave an example of this company called ABG Shipyard, which was a popular shipbuilding company at that point in time. But what was happening is that it was growing its business by taking orders and by recklessly expanding balance sheet and taking a lot of debt. So when it fell the first 20%, it would have felt nice to add, because it was, let's say in the year 2009, when the stock fell by 50%, just hearing one part of my argument would have, made you think that I should buy this stock because it's down 50 now. So instead of moving from Borivali to Churchgate, maybe from now, if it starts doing well, I can move to New York. But the question to ask was that, is this company fundamentally sound or not? Because if the company's balance sheet is bad, if it cannot survive 2-3 down cycles, and if it cannot, repay its capital, if it cannot repay its interest cost also, it is inherently a bad company, which even at any cost, you should not buy. So that is another dimension to complete the argument, Tarun, to the question that you asked is, buy what is cheap, provided it is good. Do not buy what is cheap if it is bad. So bad asset classes, bad sectors, bad. So there are many sectors which are inherently bad. Those sector economics are bad, where the sectors are so competitive that the return on equity of those sectors are less than the return on interest that you get from government bonds. So there are many sectors, like many times utilities or infrastructure or construction, which need a lot of debt to run the business, and their ROEs are just around 7, 8, 9%. They don't even meet the cost of capital. So how do you ensure that you don't get into those traps? And if also you have to buy those sectors, buy the best winners in that, or selective companies which are the stronger companies there. So or take cryptocurrency, for example. Not that I don't know much about it. So in a way, I also have shopper's knowledge when I'm talking about it. But inherently, I do know that whoever I've asked about crypto today over the last 2, 3, 4 years, just to know how to interpret, is it a asset class worth studying? No one has been able to tell me that what is the source of cash flow of this asset. कि इसमें कैश फ्लो क्यों बनेगा अगले 5 साल में, 10 साल में, या क्यों कोई और इसको आपसे खरीदेगा, या इसको भाव, इसको प्राइस कैसे कर सकते हो? तो जब तक उसका जवाब ना मिले आपको, even if it is down 20 or 30%, you cannot go in and invest just because it's down 20%. So I think you're right. Don't. So another bias that I should add, or mistake that I should add if I present you the next time, is don't buy what is down 50% just because it is down 50%. So just because it is unpopular itself is not an ingredient. It should be unpopular temporarily, but it should be inherently a good asset class. It is like this. For those of you, who have grown up watching cricket, and you had Sachin Tendulkar and you had Vinod Kambli, both started off as great cricketers with skills. But, so whenever Sachin Tendulkar would play badly for a few matches, you could put more money on him, saying that he will revert to mean. वो अपना form वापस आ जाएगा. But with Vinod Kambli, because he got distracted and went the wrong trap of, taking a lot of debt and partying and giving up his cricket practice, you could take a call कि ये सस्ता हुआ है, इसका 3 मैच खराब गया, 6 मैच खराब हुआ, जरूरी नहीं है कि 7वां मैच अच्छा खेलेगा, because उसका core practice छोड़ दिया उसने. He stopped going to practice, he stopped working out, he started eating and drinking and stuff like that. So the principle of good is more important before the principle of cheapness.
Brilliant answer. Thank you for this. Another question, and this is a question I face every day, and what you were trying to explain, I read a book by Ashwin Chavda called Wealth Allocation Framework, Kalpen, and this book speaks about, first of all, we as investor, and 95 to 97% of the people we met ask us the question, how can I increase my returns? Right? We know this is something not in your and my control, right? We may claim ourselves as superstars, but we know, right, it is not in my control, right? And I think Nicholas Taleb has spoken about black swan book and all random events happening are uncertain and all these things. He spoke about that why can't the conversation can change to how can I achieve my life financial goals with much more certainty with my investments. So I know you were also trying to talk about don't listen to things even if 50 lakh people are saying that this is the right thing. But coming to financial goals, this is more investor centric question. Kalpen, I see a lot of investors say कि boss क्या retirement, क्या children future, these are something I can achieve like this. So what is your opinion and take to people to take this seriously about moving towards their financial goals, asset allocation?
Okay, so here again, it's a very important point because just because you and I want higher returns, market is not here to make us happy. In fact, the rule says that market is like a casino. We can go there and win once in a while, or we can play there, feel excited about it. But if we don't play smartly, mostly the market wins always. So likewise in investing also, eventually it's a zero-sum game. If we make more money, it has to come from someone else. And the ratio is typically 95-5. 95% of the people who make lesser returns than the long-term average compensate for that 5% who will end up making slightly better than average. So, the question that I always ask when I have any money to invest is not how much money will I make. The question I ask always now is where will I lose less or where will I definitely not lose? What are the chances of not losing money? And I have learned that investing with that question in mind generally has helped me choose the investment portfolio in such a way that more often something good has happened and that investment has delivered better returns when versus chasing the highest returns. So coming back, my answer is that because I want higher returns is not the reason why I will get higher returns. Because we invest sensibly is why we will get higher returns. Because we invest at times using defense. See, it is not a linear game. This is not a game of cricket where if it's a 50-over match, which means 300 deliveries to be bowled, on every delivery a 4 or a 6 will be scored. There are times the pitch is difficult. There are times the bowler is very good. There are times you will be injured. There are times you will lose a wicket. There are times there will be dot balls. So knowing that in what conditions there will be dot balls, and in such conditions, instead of trying to play for a 6, you have to defend and be okay with poor returns. So when market valuations become obscene or when markets go into a bubble, the question to ask is not पैसा कहाँ बनेगा. The question to ask is यहाँ से पैसा टूटेगा तो नहीं. So क्या कर? So वहाँ पे फिर goals और asset allocation की भाषा आपको बेहतर इन्वेस्टर बनाएगी या आपको ये errors को avoid करने में help करेगी. And the rules are very simple. See, there's a very nice saying which says that whether alpha generation or extra return, when you die on your graveyard, वो जो epitaph बनता है, उस पे ये नहीं लिखा होगा कि आपने कितना टका रिटर्न बनाया. आपने 15 बनाया और आपके बाजू वाले ग्रेवयार्ड ने 13 बनाया और किसी और ने 16 बनाया, तो your return was higher than someone else. But what will matter is that when you died, did you live a great life and did you fulfill all your roles and responsibilities for your family, for yourself, and achieve your objectives? So the starting point of investing, in my view, and it has taken me almost a decade to realize what is not the dimension to worry about. The dimension to worry about is, am I fulfilling my objectives? Am I fulfilling my goals? कितना टका बनेगा वो किसी को नहीं पता है. अगले 10 साल में 12 बनेगा, 6 बनेगा, 20 बनेगा, no one knows. Imagine Japan was the biggest innovator of the world in the 1980s and 90s. And तब से आज तक 40 साल का रिटर्न जीरो है वहाँ पे. China was the fastest. If I had told you in 2008 that अगले 10 साल में the fastest growing country on earth is going to be China and not India and definitely not US, we would all, including myself, have put our money in China. But what happened? It gave the least returns, and the best returns came from a country which did not grow the fastest. So India's growth was second. US growth was lesser than India as an economy, but their stock prices made higher return because there are many other variables. So the answer here is that we cannot predict कि अगले 10 साल में यही asset class ठीक करेगा क्योंकि पिछले 5 साल में हुआ है, and hence we need to diversify. So one thesis that I have is that most often we don't know the future. most often no one knows the future. So you just, diversify sensibly, and you keep just two rules in mind. Avoid ruin. How do you avoid ruin? By not buying bad businesses and by not overpaying even for good businesses. So 1 लाख रुपए का आईफोन अगर आप 3 लाख रुपए में खरीदोगे तो कहीं भी बेचने जाओगे तो 2 लाख रुपए का नुकसान होने वाला है. Even if iPhone was the best iPhone ever made, but if you overpay for it, you will not make money. And hence, don't overpay. And second, if you buy a random, 5,000 रुपए का क्वालिटी का फोन, तो वो 5,000 में ही बिकेगा. उसकी वैल्यू कभी 20,000 30,000 नहीं होगी. तो क्वालिटी और प्राइस, यही दो चीज मैटर करती है ये पूरे इन्वेस्टमेंट में. एंड उसके बाद टाइम. और maybe I'm not able to express it well, but what I want to highlight, Tarun, is ये जो quest for returns है, it ends up becoming an outcome of risk. जब हमने returns को पकड़ने की कोशिश की है, actually risk हमारे पोर्टफोलियो में आ जाता है. On the contrary, जो दुनिया के सबसे सक्सेसफुल इन्वेस्टर्स है, उन्होंने हमेशा एक ही सवाल पूछा है कि मेरे इन्वेस्टमेंट में रिस्क कितना मैं कम करते जाऊं. Keep eliminating risk. Eventually returns are made. And eliminating risk does not mean eliminating volatility. Otherwise, a lot of people will say FD में तो कोई risk नहीं है because वो straight line का return है. वो volatility है, risk नहीं है. Risk is basically कहाँ पे promoter पैसा लेके भाग जाएगा, या कहाँ पे company बंद हो जाएगी, या कहाँ पे मैंने company को गलत भाव पे खरीद दिया. So I think focus on your objectives, your goals, your appetite for volatility, and then build a diversified portfolio. और जब मौका मिलता है, जब फुल टॉस आएगा, जब बाजार बहुत सस्ता होगा, बहुत महंगे, अच्छे स्टॉक्स 20, 30, 40% गिर जाएंगे, उस दिन जाके 6 मारने के लिए तैयार रहेगा. बट उस दिन तैयार रहने के लिए हमारे पोर्टफोलियो में डिफेंसिव एसेट क्लास भी होना जरूरी है.
So Kalpen, there are many questions. Before that, one more last question I want to ask is on concentration and concentration investing. Okay, I know big money has been made. Big people have gone there because of conviction. Big money has been made through that, right? So concentration, you think, is a bad thing in investing, or it's a good thing? At times, when you spoke about the full toss thing, right? So at times you have to play 6 on that full toss also, but timing that is not everyone's skill set, right? So how should one approach? Let's say small cap investing was one of the best thing when the pandemic broke out. Anybody invested there made 2x 3x money, right? So when to you think concentration is something investors should marry?
See, my take on this, Tarun, is it is not that concentration is rewarding or diversification is less rewarding, because it is about what are the rules around which you concentrate or diversify. If you concentrate and own wrong investments, you will die fast. In fact, let me give you some data point. ये जो concentrated investing का जो story telling या narrative पिछले 5-7 सालों से आया है, मैं हमेशा सोचता हूँ कि US का जो S&P 500 है, उसमें 500 कंपनीज है, और 80 से 85% मनी मैनेजर्स यूएस में S&P 500 को बीट नहीं कर पाते हैं, which means S&P 500 is beating 85% of capital in the most developed market of the world. It means 500 स्टॉक के डाइवर्सिफिकेशन के बाद भी आप 85% को बीट कर सकते हो. तो this data is saying that actually diversification wins and not concentration. So मेरा कहने का ये मतलब है कि ये ये लेबल जो है कंसंट्रेशन या डाइवर्सिफिकेशन का, वो मैटर नहीं करता है. मैटर क्या करता है कि अगर सही कंपनी में कंसंट्रेट किया तो पैसा बनेगा, और गलत एसेट क्लास या गलत कंपनी में कंसंट्रेट किया तो पैसा नहीं बनेगा. सो कहाँ कंसंट्रेट करते हो, कंसंट्रेशन बिल्ड करते हो, वो मैटर करेगा. लाइकवाइज अगर सही कंपनीज में डाइवर्सिफाई किया, लेट मी गिव अनदर एग्जांपल. पीटर लिंच इज वन ऑफ द आइकॉनिक इन्वेस्टर्स ऑफ द वर्ल्ड who for decades gave superior returns and beat the benchmarks. He had 1,800 stocks in his portfolios. So with that type of global diversification, he was able to beat the benchmarks because he had a certain rule. He would buy hundreds and hundreds of companies, matching similar operating parameters, similar ROEs, similar growth rates, similar return on invested capital, and so on and so forth. So क्या रूल है आपका कॉन्सेंट्रेट करने का या डाइवर्सिफाई करने का, वो डिटरमाइन करेगा कि क्या पैसा बनाओगे या नहीं बनाओगे। तो ये जो सवाल है इसको अलग लेंस से देखने की जरूरत है। सवाल ये नहीं होना चाहिए कि शुड आई कॉन्सेंट्रेट और डाइवर्सिफाई, सवाल ये होना चाहिए कि मैं कहाँ कॉन्सेंट्रेट करूँ, और अगर मुझे कंसंट्रेशन करने के बाद रिस्क ज्यादा दिख रहा है मेरे पोर्टफोलियो में, तो अब मुझे डाइवर्सिफाई करने दो। या अगर मुझे पता चलता है कि नहीं, अभी कंसंट्रेशन, अभी जैसे 2020 का माहौल आता है जब अच्छे अच्छे स्टॉक्स 50-50% नीचे है, तो आपको सिर्फ 10 स्टॉक लेके बैठ जाना है। तो अगर आपने अच्छे स्टॉक्स तब ढूंढ लिए और कुछ नहीं किया, you'll still make lot of money because good companies were at very good prices. So there are times you know concentration will work, there are times diversification will work, but you need to know what are you concentrating. That is a very important dimension.
Got it. One question from Kush, that what do you think should take a front seat, fund manager philosophy or fund house philosophy? Very interesting question.
Actually इसका मेरे पास बहुत आसान जवाब नहीं है, because actually I would say that you know a fund manager philosophy should supersede, because ultimately he is you know putting the portfolio together, and fund manager's philosophy to certain extent is influenced by a fund house, and different fund houses may have a different approach. Some fund houses will have an approach of having a common philosophy. हम इसी तरह से काम करते हैं। हमारी philosophy है of you know diversification of style. So we believe in style diversity. So we have one pool of capital managed by one you know group of fund managers, which focuses on you know high quality businesses and investing in them for long periods of time. Then we have another school of investing, which is reasonable quality businesses, but available also at reasonable prices. So these are the two broad blocks, and the third block is a mix of both. So depending on then each fund manager's strength to follow that philosophy in good and bad times, we assign the funds. So I personally look for fund manager philosophy. I don't look at fund house philosophy. And my approach is, you know, if you were to tell me the way I invest, if let's say I have 100 rupees, and let's say I have to invest that 100 rupees only in equity funds, as an example. So I look for the three styles that I have: growth and quality. Quality and values are second style. So we don't have any style which is about buying only cheap. You know, that cheap also has to be from good companies. So either it is, you know, growth style, value style, and blend. So I invest in all three, one third, one third, one third. At the end of 1 year, when I have new money to invest, I will see which style has underperformed in the last 1 year, and I will increasingly invest in the underperforming style, so that I again become one third, one third, one third, and you know keep doing it again and again every year. I believe that has helped me generate better returns than the broad benchmark at slightly lesser volatility, because every style mean reverts. From outperformance, it will go down to average performance and below average performance, and likewise a below average performance will also move up, because inherently all the two styles have the common principle of quality. So focus on my bias is to focus on a fund manager ideology, not necessarily fund house ideology.
So we have a question from Stephen, that if you have a irregular investment surplus, and this is very common for business owners, unlike professionals who have a very regular income flow coming in, how can you craft a allocation plan? And his second question is, how do you normalize for network effect with respect to stock and asset class opinions?
The first question, Tarun, you are the best judge in terms of how to plan cash flows and how to invest. And as rightly asked, if your cash flows are not consistent, then obviously you cannot build a consistent asset allocation. You'll have to keep in, you'll have to make certain assumptions that this cash flows will be available for what time or not be available for what time, and accordingly build your asset allocation. And it's a unique situation, so I can't really comment on that, but it needs a more specialization, customization of building the asset allocation plan. I did not understand the second question. If you can just help me understand that.
How do you normalize for network effect with respect to stock asset class opinions? So, again, this network effect means the herd mentality thing only, right? Most of the time, these asset classes opinions are made in the network, right?
So, typically when crowds start chasing something, that asset class will do very well, or that stock will do very well, as long as that stock or that strategy is still grounded in the two core principles of not becoming a bubble or getting overpriced, or still remaining inherently a good business or a good company or a good sector, you stay put, and you can just tweak your asset allocation if it is crossing your thresholds of exposure that you have mandated. To give an example, in the year 2020, when oil prices had dropped to zero temporarily, I had invested some 5% of my portfolio into our natural resources fund. It's a thematic fund which invests in metal companies and energy companies, and it continued to go down for a few more weeks, but I was fine with it because inherently I knew that इसमें पैसा टूटेगा नहीं, because आपने वो भाव पे खरीदा है कि जहाँ पे oil zero रह नहीं सकता है, और all these companies are also generating free cash flow, so someday it would have made money. As it turned out, in the next 15-20 months, these stocks really took off. So a lot of energy companies went up by 200-300%. Metal companies went up, and that 5% exposure eventually became 11% of the portfolio. Now, I didn't know when to get out, because the broad thesis of profitability of metal companies, broadly remaining intact was there, but the stock prices were really very high. So what did I do? I trimmed half of it. Capital वापस ले लिया, profit को रहने दिया. उसके बाद some of them have fallen by 20-25%. Now I don't know whether they'll fall 20% more or they will rise from here, but at least I've got my capital back. So there is no scientifically right answer, but this is how you can approach your asset allocation whenever the network. So particularly for this category of metals and energy, just 6 months back, everyone started jumping in. Everyone started talking कि ये super cycle है, ये फिर से commodity का bull run आएगा और super bull run आएगा. So that was a sign of risk. That was the first sign of red flags that अब network इस पे चढ़ रहा है. तो छोटे-छोटे retail investor भी इसमें ये game में आ रहे हैं. You don't want to be aggressively invested when past 1 year return is like 150%, and the crowds are also talking about it. So that is a sign of moderating your risk and getting out to some extent.
I know you may not like this question, but still Parag is asking that what is your take on global recession? Will global recession set back India growth story, or it is discounted by market?
So definitely global recession will have an impact on our growth also, because we are not an island which lives in isolation. In fact, 40-45% of the profits of Nifty companies come from global markets. So today, for example, Tata Motors has a very large 40% of its profits comes from global markets. Pharma companies have 20-40% of their profits coming globally. Tech companies, almost 70-80% of profits come from global companies. Engineering companies again are more export-led. So clearly, global slowdown will have an impact on India. To some, I don't think Indian market में अभी कुछ price हुआ है, because मैं देख रहा था अभी पिछले 1 साल का भी इंडिया का निफ्टी का रिटर्न सिर्फ 2% नेगेटिव है. तो हमारा पीक क्या था? सेंसेक्स 60,000 था, आज 58 या 57 पे होगा. So from its peak, we are down only 4 or 5%. We have not yet seen any major sort of price correction purely led by global slowdown worries. So the worries are there, but because there is so much of flow in Indian markets, and so far Indian companies are not demonstrating any weakness because of slowdown in their revenues or significant escalation in their cost structures. So far all is well. But if there is a deeper recession globally, then India definitely will be affected. If it is a shallow recession, then India can chart its own path, because some large parts of our markets are inward looking. They are domestic markets. So, they can be less exposed to the global cycle. So it is a function of whether it's going to be a shallow recession or a deep recession. I genuinely don't have an answer कि ये shallow होगा या deep होगा. We will play along as we go through it.
There's a question on the debt markets. I know interest rates, inflation is at the peak level and expected to go further. So in this environment, in terms of product selection, question is thoughts on target maturity fund versus ultra short-term fund investment. Any take which you feel is the preferred mode in the debt investment currently?
Yeah. So see, debt mein na, normally interest rates in India fluctuate between 6% at its low, and they rise very sharply in panic periods or when there is very large currency volatility. They go up to as high as 9% also. So this is the 10-year G-Sec. So the 10-year G-Sec has gone down to 5% also, generally in past cycles. This time it went down till 6. It did not go below 6. and currently it is at 7.5. So 7.5 is its long-term average. It's not very low, it's not very high, it's not very attractive, it's not very prohibitive कि बहुत कम है. It's somewhere in the middle. My very crude framework is 6 से 7 में जब इंटरेस्ट रेट होते हैं तब अल्ट्रा शॉर्ट टर्म में इन्वेस्ट करो, 7 से 8 के बैंड में होते हैं तो शॉर्ट टर्म फंड्स में इन्वेस्ट करो, और 8 से 9 के बैंड में जब होते हैं तो लॉन्ग टर्म फंड्स में इन्वेस्ट करो, लॉन्ग ड्यूरेशन फंड्स में. I think we are somewhere in the middle right now. So if you have 3 or 4 year target maturity funds, that's fine, because over the next year or two, when the rate cycle turns, these funds also will have lower maturity. My personal bias, even though we promote a lot of target maturity funds ourselves, but I'm more biased to have short-term fund in my portfolio because I've invested in short-term funds for the last 22 years, and they've generally delivered, with lower volatility, similar returns as long-term funds, and they have the flexibility to adjust the portfolio depending on how interest rates move. So target maturity funds are good because they are simple to understand. आपको मालूम है कि ये 4 साल की इसकी target maturity है और आज 7% मिलने वाला है, तो you'll get that 7. Whereas a short-term fund may give 7.3, may give 6.7. It can give returns in that range. If you are with a good short-term fund manager, you might get slightly more than your prevailing rate. Why do I like short-term funds even today? Is because if world over we are not able to control inflation, and that continues to put pressure on central banks to keep raising rates, then some of these long duration target maturity fund initially will still have mark-to-market loss. So if you're buying a 10-year target maturity or an 8-year target maturity, you might still suffer. So I would prefer a short-term fund till rates remain up to 8%. If they cross above 8, which means most of the risk is now getting reflected in the yield, is when you can go towards long duration target maturity fund. But it can happen that inflation starts coming down and interest rates, what we are seeing today becomes the peak for the next 2-3 years. They do not go to 8 or 9. So then my view goes wrong because my short-term fund will not have longer maturity. So the second choice could be you split between the two. The probability of whether rates will rise or fall today, I'm more inclined to say rates will rise, seeing how inflation is remaining high. World over, central banks have printed billions of dollars of money, and someone has to pay a price, so interest rates have to be higher. So my bias is for short-term fund. But if one of the slide I said is do not believe in experts like me. If you want to take that slightly contra call, you can do a blend of both. Short-term and TMF ka 50-50 kar lo.
I'm coming to end of our session. Last 2 questions, Kalpen. There is a bias called self-attribution bias, and I come across a lot of investors who feel investing directly versus through vehicles like mutual fund, PMS, they feel that ETFs and all these things, these are too simplistic. And in bull market, everybody wants to become a fund manager himself, right? So is this time different? I think this is a question, right? How do you address such people, right? Who feel that I can make more money by investing in direct equity? Any insights? Any?
तो तरुण, ये जो सेल्फ एट्रीब्यूशन का बायस है या ओवर कॉन्फिडेंस का बायस है, इसका सोल्यूशन एक ही है कि ट्राई इट आउट, डू इट ऑन सम पार्ट ऑफ योर कैपिटल. Let's say start with 10% of your capital, try it out, see whether it works for you or not. If it works for you, then obviously it is not overconfidence, but it is genuine confidence. If it doesn't work, then be humble enough to acknowledge that my core competence is not in doing portfolio construction, but in earning money through my salary or business. So then you give it to an advisor who will guide, and or money managers who are professionals doing this job day in and day out. So I would say that if you have to try it out first with a small part of your portfolio rather than a large part of your portfolio. And once you realize whether if it doesn't work, then accept that. Now let's look at data. ये तो opinion हो गया. अब आप डेटा देखते हैं. आप देखोगे जीरोधा जो इंडिया का सबसे बड़ा डिस्काउंट ब्रोकर है, 1 करोड़ लोग उसके प्लेटफॉर्म पे ब्रोकिंग या डायरेक्ट इक्विटी करते हैं, बाय सेल एक्सेट्रा एक्सेट्रा. And they have data every day of all their 1 crore investors and their holding period returns. And Nitin Kamath has written this publicly that most investors have not made more than 6% return. which is FD का return या in some cases even savings account का return. Few investors have made more. So the question to ask is, can you be one of those few? And what are the rules of those few? If you know those rules and if you can execute that, and if you can have that temperament, by all means, you don't need any one of us or our services. You can, and there's nothing to say that you have to give money to a money manager. But पहले डेटा देखिए, सेकंड अपने स्किल्स को ऑनेस्टली असेस कीजिए, थर्ड ये देखिए कि आपके पास कितना टाइम है इस एक्टिविटी पे डिवोट करने का. मेरा खुद का ये मानना है कि in spite of being a CEO of a very respected fund house, and in spite of being in this business for 24 years now, I do not get the time to, I can read balance sheets, I can understand managements, I can, I have the temperament, I have the discipline, I have, read everything in the world related to investing, but I still do not get the time to do a very honest job of directly building the portfolio. And hence I will outsource it to a fund manager who I know day in and day out will only do this. So and of course this is my salary also speaking, because I make more money if people invest in mutual funds. But I genuinely feel that world over data says that the temperament required to be a good investor is generally a rare temperament to achieve, and which is why it's better to have professionals to help you. You still want to try it out, do it, but on a small part of your portfolio. Don't experiment on your entire portfolio. I have friends who are advisors like you, Tarun, who have been in the business for 25 years. One of them was telling me, and he manages very large clients. Some of them are like cricketers and celebrities. And he had given them a link. कि आप ये लिंक में आपका जितना भी डीमैट अकाउंट और ब्रोकिंग का स्टेटमेंट है उसको अपलोड कर दीजिए. कौन से दिन आपने कौन सा शेयर क्या भाव पे खरीदा, कौन सा शेयर क्या भाव पे बेचा, कौन से शेयर का आज क्या भाव है. और जब तो रफली 240 इन्वेस्टर्स के साथ ही एक्सरसाइज किया उसने. And that data showed him that 240 out of 240 had not even beaten Nifty as an index. Because what happens is we buy stocks, once they have run up a lot, or we get out of them when we are a bit late. So कुछ नहीं करके सिर्फ निफ्टी में भी डाल दिया होता तो they would have won better returns. So that is, I think, data indicates that by design, by God's design, we have not been wired to become good investors. So either we learn how to become good investors, and it's not easy, according to me.
And again, this is a question of opportunity cost also, right? Whether you focus this much time on your business or your job, or you put this time on investing.
Exactly, exactly.
Right. So I am coming to my last question, and this question we ask every guest who comes on this masterclass. And this is, which are the books which has shaped you as a person, Kalpen? And again, maybe you want to share some of the influential books in your career and life you have gone through, and which has really helped you shape as a person you are.
Sure. So one book which has really helped me, learn that why most of us are bad investors, and because we are behaviorally, genetically wired to be bad investors. And genetics ka wiring is a wiring of lakhs of years. It's not about 100, 200 years. Market 200 साल से है, but अपना genetic wiring तो लाखों सालों से है. तो वो किताब में दिखाते हैं कि कैसे हम गलतियां करते हैं, कैसे हम डिसीजन मेकिंग में एरर्स करते हैं, लाइफ के डिसीजंस और इन्वेस्टिंग के डिसीजंस. और वो पढ़ने से हमें एक समझ मिलती है कि ये गलतियां हम कैसे मिनिमाइज कर सके. तो इस किताब का नाम है द आर्ट ऑफ थिंकिंग क्लियरली बाय रॉल्फ डुबेली. It's a beautiful book, written in very simple language, day-to-day life examples of how do we make thinking errors, and which lead us to bad portfolio decisions. So that's a good book to read. Then another good book to read, which tells us about the futility of making forecasts and predictions and relying excessively on experts, is a book by Morgan Housel called The Psychology of Money. He's given beautiful examples of how most things in the world happen the way they are supposed to happen. They don't happen the way we want them to happen. And he's connected that in a very interesting way to our investing lives. Then another important book to read, which is a very powerful concept, which will awaken us. And that concept is that the world itself is an outcome of randomness. The fact that 99.99% species ever born in the universe have not survived, and as of now we as a human race have survived, is an act of massive randomness. तो अगर हमारा सर्वाइवल ही रैंडमनेस का आउटकम है, तो इन्वेस्टिंग में हम क्या मतलब प्रिसिशन और परफेक्शन को खोजने की कोशिश करते हैं. तो ये किताब बताती है कि पूरी दुनिया, पूरा यूनिवर्स रैंडमनेस पे चलता है, और हम we get fooled by that randomness, and we try to look for patterns and certainty in what does not have a pattern, and then we form wrong patterns and take wrong decisions. So this is a book called Fooled by Randomness. Yeah, Vikram, you got it right. Fooled by Randomness by Nassim Taleb. थोड़ी कॉम्प्लेक्स है ये किताब, बट बहुत ही पावरफुल कॉन्सेप्ट है. ये 2-3 किताब पढ़ने के बाद मेरे 10-15 साल के पूरे फंडे चेंज हो गए. और अगर आपको अच्छे बिजनेसेस के बारे में समझना है, अच्छा इन्वेस्टर बनना है, तो एनीथिंग रिटन बाय वॉरेन बफेट और बाय हिज गुरु बेन ग्राहम आर और इस पे तो हजारों किताबें हैं. जैसे वॉरेन बफेट के वो हर साल अपना एनुअल लेटर लिखते हैं अपने इन्वेस्टर्स और शेयर होल्डर्स को, जिसमें वो अपने हर कंपनीज के ऑपरेटिंग परफॉर्मेंस पे बात करते हैं. लेकिन वो बात करने में कुछ रूल्स बताते हैं, कुछ प्रिंसिपल्स बताते हैं. So any book, so there is a book by him called Letter to Shareholders by him. Is again a great book, but you may want to read it a bit later after you've gone through the first 2-3 books that I highlighted. So these are 3-4 books that I many times go back and read again.
Thank you, Kalpen, for sharing so openly and candidly with us. And I'm sure I had many takeaways from this session. And it actually helped me reflect back that how I can, for myself as for my clients, how can I do better? And I'm sure all of you had some very good insights to take away. Thank you very much, Kalpen, for joining us. And I wish you all the best. Thank you.
So Tarun, first of all, thanks for inviting me. And I have known you for more than now 15 years. And I would like to publicly acknowledge that you're one of the very few advisors who have stuck to a certain purpose of doing good and sticking to the right things, because that is not easy. It is very easy to get carried away, but you've remained true to your line and length, and which is why it's always a pleasure to come and talk to you. So thanks for inviting me, and all the best to all of you who have spent your Friday evening listening to me. Thank you.
Thank you very much.
Have a nice weekend.
Thank you.
Bye, Tarun.